Now we will discuss issuing procedures and some basic terminology. The board approves the number of bonds authorized, their par value, and the contract interest rate. A bond indenture is the legal contract between the bond issuer and the bondholders. It identifies the obligations and rights of each party. A bondholder may also receive a bond certificate as evidence of the company's debt. The par value of a bond, also known as face value, is paid at a stated future date. This future date is called the maturity date. Therefore, on the maturity date, the issuer will pay the bondholder the par value of the bond. The contract rate is also known as the coupon rate, stated rate, or nominal rate. This is the annual interest rate paid by the issuer of bonds. This amount is applied to the par value. And in this course, interest is paid semi-annually, which is twice a year, every 6 months. Bonds are securities and can be readily bought and sold. Bonds are usually less risky than stocks. A bond issue is the sale of bonds, usually in denominations of $1,000 or $5,000 or even higher. The market value or market price is shown as a percentage of par value or the face value. It is usually a quoted price. An example is if bonds are issued at 97, it means that they are sold for 97% of the par value. Another example is if bonds are issued at 103, that means that they are sold for 103% of the par value. The bond rate is the interest rate on the bonds. Market rate is the annual rate borrowers are willing to pay and lenders are willing to accept for a particular bond and its risk level. When the contract rate and the market rate are equal, bonds sell at par value, meaning that a $1,000 par value bond will sell for exactly $1,000. When the contract rate is above the market rate, bonds sell at a premium or above par, meaning I can have a $1,000 par value bond that sells for $1,100. When the contract rate is below the market rate, bonds sell at a discount or below par, meaning I can have a $1,000 par value bond that sells for $900. Regardless, if the bonds sell at par, at a premium, or at a discount, the interest rate will stay the same because it's based on the par value. And the amount that bondholder receives at maturity will also be the same regardless of how the bond sells initially. Regardless if the bondholder pays more or less for the bond, they will only get back the par value at maturity. I have some students who ask, why would anyone pay more for a bond if they're not going to get it all back in the end? It is because of the interest. The bondholder is earning interest throughout the life of the bond, and they're willing to pay more because of an attractive interest rate. In the end, the bondholder will actually come out ahead, not behind. The issuing procedures are somewhat similar to issuing stock, with a few minor adjustments. There are still 3 steps. The first step is the same as with issuing stock. We need to debit cash for the amount the company is receiving from selling the bond. The cash amount could be for the par amount, or it could be higher or lower. You would multiply the par value by the quoted rate. The second step is also similar to issuing stock. Instead of using the stock account, we use the bond account. Remember, bonds are debts, therefore this is a liability account. We use the account bonds payable. The amount would be the par value, same as with issuing stock. The third step is where there are a few more differences. You still find the difference between the debit and credit columns, but in this case, it will be either a debit or a credit. We do not use the paid in capital account because we are not dealing with stock. Instead, we call it a discount or a premium on bonds payable. You will never use both of these accounts at the same time. You will either use one of them or none. If the company receives more cash than the par value, then it was sold at a premium. If the company is receiving less cash, then the par value, and it was sold at a discount. If the bonds were sold at par exactly, then you would not use either of those accounts. Next, we will be looking at the entries for paying out interest. Remember that interest is an expense and expenses have debit balances. You will debit the bond interest expense account for the amount that you're paying out in interest. To calculate the interest amount, you multiply the interest rate by the par value, which gives you interest for an entire year. In finance, percents are usually based on an annual basis. Earlier, I stated that in our examples, interest will be paid out semi-annual, which means twice a year. You would take the annual amount and then divide it in half, or divide by 2, to calculate interest on a semi-annual basis. The second step is to credit the cash account because the company has to pay out cash to the bondholders. It would be for the same amount as the debit. It does not matter whether the bonds were issued at par, at a discount, or at a premium. Interest will be the same regardless. It is based off the par value, not the cash value.